Hello everybody and welcome to our Hurst Signals webinar for the 4th of June 2014. While everybody connects and establishes themselves in the webinar room, let's take a look at our disclaimers. Here we go. Please make sure that you have read and understood these disclaimers before we take a look at the market. They are very important, and of course they are legally obliged. So it's very important that you have understood them. I have another disclaimer to add today. You might notice from my voice that I'm suffering from a bad cold. It's a bad cold that has brought a really nasty cough with it. It was passed on to me by my 5-year-old son, who brought it home from his infant disease dissemination center, which calls itself a school. And so I'm struggling with a heavy cold. I do apologize in advance if it interrupts the broadcast at all. If I go silent, it's probably because I've turned off my microphone in order to cough. If I don't get to that microphone switch in time, then I apologize as well. But let's see how we do. For that reason, today's webinar might be a little bit shorter than usual. We normally try to aim for 30 minutes, for half an hour. But if my voice doesn't hold out, then please bear with me. We'll simply bring the webinar to end a little bit earlier than usual. Right, well, let's take a look at the markets. If you have any questions, please put them into the chat window. We're using this new system, Webinar Jam, which uses Google Hangouts. It's all very complicated. I don't really know how it all works, but somehow or another we're all able to connect online, and you'll see there's a chat window in the right-hand side of your screen. And so ask me any questions that you might have. I have a few questions that we've received by email, and a question from Hurst Chat, so I'm going to deal with those as well. But if you have any questions, please put them into the chat window. Bear in mind that there is quite a big delay on this system. In fact, in the tests that we've done, it would seem that delay is sometimes as much as a minute. So please don't be upset if you ask a question and you only hear me replying to it more than a minute later. Okay, I find it a bit disconcerting, but hopefully we can all work with it. So let's take a look at the markets, and the first market that I thought I would look at was the S&P 500. Here is the 3-month view of the S&P 500. Let me just zoom in on that view so that hopefully you can see it a little more clearly. Of course, in Hurst Signals, in case you don't know this, it's very simple to zoom in on a chart. You simply click on it, and there are 4 different levels of zoom. Depending on your screen resolution, of course, the chart will be displayed at a different size, so that's why there are 4 different levels of zoom. Right, the question I wanted to answer here has to do with the recent very strong upwards move. And in fact, the question was, could we have known, or did we know from the cycles, that we were going to get such a big, strong move up? Now, I hope you can see my mouse on your screens. I believe you can. Last webinar, I experimented with a drawing tool, but it was a little bit clumsy, so I'm going to just simply use my mouse to illustrate things today. Hopefully that'll work. So you can see this really big, strong move that we've had over the past 2 weeks. And the question was, could we have known that the market was going to move so strongly because of what was happening in the cycles? And the honest answer is no, not necessarily. We couldn't tell that the market was going to move up so strongly. There were a few clues, and I thought it'd be interesting just to go through what those clues were so that you can see how we use cycles to understand what's happening in the market. Cycles give you a very valuable insight into what's happening in the markets, and they help you to understand what might be going to happen next. But they don't. Cycles aren't a crystal ball, if you like. You can't look at cycles and with 100% certainty say, oh, I know exactly what is going to happen, because you don't. But when you analyze markets on the basis of cycles, you generally have a very good idea about what's going to happen. And in particular, and this is the really important point, when you're making trades using cycles, you will generally find that even though you didn't know to expect such a strong move, you would have positioned yourself correctly for that move. Okay, so in other words, as you can see on this chart, we would have got into a long trade. That's that E category, that's that E label over there. The E label is labeling the interaction between price and the FLD, which is of course what we trade using Hurst Signals. We trade the interaction of price with that FLD. In other words, in simple terms, when price crosses the FLD, we enter into a trade. And so when price crossed up above that FLD, we entered into a long, what we call an E category trade, because there is, of course, a sequence of trades. As you can see, the sequence goes from A, B, C, D, E, F, G, H. So there are 8 interactions. There's a sequence from A through to H. And so what happens when you're trading using cycles is that you will find that you are correctly positioned thanks to the cycles. You might not have expected such a strong move, but you were correctly positioned. Now, what were some of the clues that we could have used to recognize the fact that there was going to be such a strong move? And there were only clues, there were only suggestions, there wasn't any absolute hard evidence. Cyclic analysis is as much an art form as it is a science. It's something that you practice and you get good at it the more you do it, and you'll learn to notice a few of these signs. So what is the first sign that occurred to us or that was presented to us that would have let us know that we were in for a very big, strong move up? Well, the first sign was what happened to this D category interaction. Can you see that letter D over there? Okay, that is where price came down below the FLD. Now, what we normally expect when price interacts with the FLD in the position of a D category interaction, and as I've mentioned, this is a sequence that we trade. It's a regular, repeatable sequence measured from the most recent 80-day cycle. Here is that 80-day cycle marked on the chart. I think it was Monday the 14th of April. And you can see there have been 50 bars since that trough. And so the D category interaction is the 4th interaction since the formation of that 80-day cycle trough in the markets. Now, usually a D category interaction is a good short trading opportunity. You will learn to recognize the more you do this, and I hope that many of you are already recognizing the character of the different interactions. And a D category interaction usually has a character which is that it very accurately achieves its target before turning back up again. Now, in between the D category interaction and the E category interaction is the 40-day cycle trough. As you can see, here is that 40-day cycle trough marked with these diamonds. If you don't understand what these diamonds are, then take a look at the wealth of material we have on our website, which introduces you to Hurst cyclic analysis and ways of presenting the analysis. But in simple terms, these diamonds represent the position of troughs of various cycles. The taller the pile of diamonds, the longer is the cycle wavelength that is experiencing a trough at that time. And so following the D category interaction, the 40-day cycle trough will form in the market. Now, usually, as I was saying, the D category interaction is a good short trading opportunity. And here you can see earlier in the chart, I do hope you can see my mouse, but earlier in the chart, back in early March, was a previous D category interaction as price came down to the 40-day cycle trough over there on the 17th of March. And you can see that that was a typical D category interaction, in that the target that was generated by the cross, which is very simply calculated from the previous peak to the level of the FLD at the point at which it was crossed by the median price, which is a subtlety you don't really need to worry about, but that the distance from the peak to the FLD is extended below that and so that would have brought us to a level of about 1840, very roughly, or 1835 perhaps. And usually that target is very accurately achieved in a D category interaction. Now, I think that you can see that there it was fairly accurately achieved. On the day of the 17th of March, price went down below the target, but probably only for a few hours, and then it bounced back up again, and we were into our next interaction. That is a typical D category interaction. Now, what happened in the middle of May? Was that 3 weeks ago? Yes, 3 weeks ago. We had a D category interaction as price came down, crossed below the FLD to form the 40-day cycle trough. But can you see what happened? It came down to the FLD, then it sort of stuck to that FLD, and it didn't manage to rid itself of the FLD. It clung to it. It did what we call tracking along the FLD. And it by no means went down and achieved its target. If we very roughly use the grid lines to calculate the target from a peak of roughly 1900 to a cross level of about 1870 perhaps, is 30 points, and so we would expect another target of about 1840. And as you can see, price came nowhere near that lower target. So what was happening? What did that tell us? Well, as we watched price clinging to that FLD or tracking along that FLD, it was clear that something was happening in the market. And what that something was that the cycles were not able to fulfill their downside projection. In other words, we had a good downside projection for that 40-day cycle trough at 1840. Price got nowhere near it. Price clung to the FLD, and it was a warning sign that there was something wrong. Well, not something wrong, it was a warning sign that there was some additional or unexpected bullishness coming into the market. So could we have known that we were going to see a very big bull move? I don't think, to be absolutely honest, that we could have known the extent of the bull move that we have seen, but there certainly was an indication by the fact that the D category interaction did not anywhere near reach its target. There was an indication that there was a lot of bullishness coming into that market. And it was really only completely evident over here, which was that would have been the third day. That would have been 21st of May. So it was only really completely evident and completely clear on the 21st of May that bullishness had very strongly come into that market, and at that point we would have cut our losses on the D category short trade if we hadn't done so earlier, and we would have prepared to enter into the E category long trade, because we would have identified the fact that there was bullishness coming into the market. That's the first clue. What would have been the other clue? The other clue, and I'm just going to mention this briefly and then move on. I wrote a blog post about it, so please take a look at the blog post that I wrote. It was only last week, I think, a longer cycle view, which speaks about the fact that price was tracking along this FLD for such a long period of time. Now, between the B category and C category interactions, we expect price to track along the FLD, usually for about a week or a few days to a week. But as you can see, what happened over here is that price came down to the FLD very accurately, evidence of the power of that FLD line. Price comes down very accurately to the FLD. That was on the Friday of the 21st of April, so I guess that would have been about the 25th of April. And then price tracked along the FLD for the next 1 week, 2 weeks. On the third week, it finally broke clear, but only for 2 days, and then it came back down to it. So for about 4 weeks, it was tracking along that FLD. Now, that is a warning sign. When you see markets behaving in a way that is not entirely as we expect, then you have to take a step back and you have to say something is going on here. And if you take a look at that blog post that I wrote about a longer cycle view, you can see what I think might be happening. and you'll notice that I discussed the interaction between price and the 80-day cycle FLD, which would have warned us, or would have told us, informed us, that there was a good, strong bullish move coming. So that's my answer to would the cycles have told us about this very strong bullish move that we've seen over the past 10 days? I believe that the cycles gave us clues that it was coming, but at the worst case scenario, even if you hadn't identified those clues, trading using the FLD trading strategy, you would have been correctly positioned. In other words, we would have been in a long trade. We wouldn't have been in a short trade for the duration of this long bullish move. If you just joined us, then I apologize for the fact that my voice is a little bit rough. I am suffering from a fairly heavy cold, so I'm going to keep today's webinar fairly short. We're already halfway through it, so apologies for the rough voice, but let's move on. I'm going to try to cover 2 other questions. If you have any other questions, please put them into the chat window. Bear in mind there is about a 1-minute delay in the system, and so it may take me a little while to reply to your questions. The next question that I would like to answer is an interesting question that was asked in Hurst chat this morning, which has to do with that 40-day cycle trough. Now, if you're a complete beginner, then please bear with me. I'm going to speak about a few things that are perhaps a little more advanced in terms of cyclic analysis here, but I hope you find it interesting. As you can see, the 40-week cycle trough in this chart, this is the 3-month view of the British pound to US dollar forex pair. The 40-week cycle trough has been positioned in early April, so that must be about the 4th or 5th of April, and the question is a fairly obvious one. Why is that 40-week cycle trough positioned at that trough position and not at this more obvious trough position over here on the 24th of March? Well, it's a very good question, and let me answer it. First of all, you must understand that the Hurst Signals service is powered, of course, by Sentient Trader, which is software which is analyzing the markets according to the cycles that are present in them. Now, most of the time, and by most of the time I mean really, 95% of the time, I don't know what the percentage is, but most of the time, the cycles are clear in the market, particularly when you're looking at an end-of-day picture. But there are times when the cycles aren't clear. And that is what has been happening in the British pound to US dollar recently. So let's take a look. I've taken a few screenshots using Sentient Trader of a slightly longer term view. In Hurst Signals we present 3 views, a 3-month view, a 6-week view, and an overview. And none of them show very clearly the reason behind that incorrect placement or the slightly questionable placement of the 40-week cycle trough. I notice a question from Ahmed. Do you give live training? Yes, Ahmed, over the years we've done various things, including webinars. This webinar that you've come to today is very much just a quick touch base, not so much live training. But we've experimented with various things, including webinars, online training. We've done quite a lot of that, workshops. I have also given workshops live and in person, which I really enjoy. So yes, we do. Send an email to info@sentienttrader.com or info@hurstsignals.com and express your interest, and we will certainly see what we can do. Here's a screenshot that I took from Sentient Trader that I'm just running here on my computer, and in fact, let me show you this one here. Okay, this shows a slightly longer view. It goes all the way back to November of 2013. Now, you can see that I've counted some bars using the bar counting tool in Sentient Trader. And the bars that I've counted have been from the very prominent trough in the first week of February, and the trough that is more probably the correct placement of the 40-week cycle trough. You can see that there were only 47 bars between those two troughs. So now, why is that 40-week cycle trough in the first week of April as opposed to about 10 days earlier in the last week of March? The reason has to do with the analysis that comes before it. Usually, the cycles are really clear in the market, and you can see them and you can analyze them clearly, and there aren't very many ambiguities. But here, as I think you can see, there is a definite ambiguity, because we have a very strong trough here in the first week of February, a very strong trough, and there were only 47 days until the next very strong trough. Okay, so what the system does is it tries every possibility. It considers, in fact, it considers millions of possibilities in terms of which trough could be a trough of which cycle and all that kind of thing. It has various hard and fast rules that it follows, and one of the rules that it follows is that an 80-day cycle trough cannot be shorter than 51 days. Okay, I won't bore you with the details about why that is, but 51 days is pretty much the minimum length for an 80-day cycle. So there we had 47 days. So what the software has done is it said, okay, either this trough in February is incorrect, or this trough in March is incorrect. Now, by incorrect, what do I mean? Well, an interesting thing happens in the markets. Most of the time, they move with a great deal of very obvious cyclic momentum, if you like. You can see the cycles. You can just look at them and you can see them. And this is where I need my drawing tool to start drawing cycle shapes. But if you watch any of my videos, you can see I'm always drawing cycle shapes over the market because they're always present in those markets. But sometimes you get you get a deviation from the very regular cycle movement that we're able to observe. Hurst referred to something called fundamental interaction, which is where you get something happening, usually something such as outside news, a news event or a big dramatic thing happens, and as a result the market will bounce very strongly, either upwards or downwards. A true sign of a fundamental interaction is that it doesn't last very long and the market bounces straight back again. Now, look at this first week of February. I'm not saying that this is definitely fundamental interaction, but I would say that it looks as if though the market has been pulled down, perhaps a little bit further than it would have moved usually using purely cyclic reasoning, and perhaps that trough should have been just a little bit higher. Notice how on the Monday of that week it came down very hard. It spent the week sort of sitting at that level. Then on the Friday it bounced straight back up again. That strong move down and then the strong move back up is often a sign of fundamental interaction. Not always, but it often is a sign of that. So it is quite possible that this first week in February was an example of where the markets were stretched by some form of fundamental interaction. Perhaps there was a news event that occurred in that week. I cannot think at the moment what that might have been, but perhaps there was some kind of a news event that affected the British pound US dollar and caused it to stretch slightly downwards. What will usually happen in on the occasion of a fundamental interaction is that the market will move more strongly in the direction that the cycles were causing it to move anyway, but then it will bounce back up again. Okay, so that is possible. It is possible that the 80-day cycle trough should more correctly be placed in the middle of January of 2014, as you can see over here. That trough over there, perhaps that is in fact the correct placement of the 80-day cycle trough, which would mean that the 40-week cycle trough would occur here on the 24th of March. That would resolve the problem. Now, as a matter of interest, because obviously we monitor the charts that are being sent out on Hurst Signals, and why haven't we changed that? Over the years, and I created Sentient Trader, and I'm the most experienced Sentient Trader user there is, I believe. And over the years, I have learned that interfering with Sentient Trader's automatic analysis process often means that you end up with a poorer analysis. So that's the first point. Although it seems fairly obvious that we should shift that 80-day cycle trough, and therefore the 40-week cycle trough will be shifted, it seems fairly obvious. I am nevertheless fairly reluctant to do it. That's the first point, but we might well soon be doing it. But here's another more important point. Do you notice the identification of the interactions between price and the FLD? B, C, D, E, F. Okay, those are the interactions of between price and the FLD. The main reason why we haven't moved that 40-week cycle trough is because the Hurst Signals system is presenting two sources of information, if you like. There is the analysis, which is presented using those diamonds at the foot of the chart, which is very useful when you're looking at the analysis. Obviously, you want to use that analysis, you want to look at it, and you want to make trading decisions on the basis of it. But the other source of information that the Hurst Signals system provides is the identification of the interaction between the price and the FLD. Now, most of the time, the analysis and the interaction between price and the FLD is telling you exactly the same thing. In this example, with the British pound and US dollar, and let me click on that chart to just make it a little bit larger so you can see it more clearly. In this example, the analysis and the identification of price and FLD interaction is not telling us anything different. They're not providing us with any different information. But you will notice that the identification of the interaction between price and the FLD has actually overruled the discrepancy in the analysis. Do you see that? Here is the 40-week cycle trough at the foot of the chart. The first interaction following that should be the A category interaction. But notice in the identification of the interactions that it is in fact labeling that interaction as the B category interaction. Why? Because the process which identifies the interaction between price and the FLD has actually overruled the analysis. And it has done, I think it was Stuart who asked this question, it has done what Stuart thought to himself when he asked the question. It has said, no, that trough shouldn't be there, it should be over there. And as a result, it has identified the interaction between price and the FLD regardless of the potential misplacement of that 40-week cycle trough. If we look a little bit further ahead in the analysis, you'll see there is a very clear trough over here. And of course, now that I have zoomed in, I can't see that date. That would have been the 3rd week of May, about the 15th of May or something like that. And so that 40-day cycle trough on the 15th of May looks like a very good position for the 40-day cycle trough. And so because that looks like a good position for that trough, there's no reason to reject this analysis entirely out of hand. The only thing that has happened is that the 40-week cycle trough placement looks wrong, and it is slightly displaced, as you can see, to the right. And but that is not affecting our identification of the next trading opportunity, because that is in fact still happening correctly, because the identification of interactions between price and the FLD is still looking very good, regardless of the fact that that trough looks slightly out of place. So I hope that answers that question. A very interesting question. I hope it wasn't too advanced for the newcomers. I hope that nevertheless you found it interesting. I think that perhaps both of the questions that I've covered in today's webinar really highlight the same really important point about using cycles in terms of analyzing a financial market and in terms of making trading decisions. And that really important point is that cyclic analysis is an art, and Hurst Signals is a means of of mechanizing it, if you like. We generate signals, but lying at the heart of it, there is nevertheless an art to producing those signals and to understanding them and to understanding the cyclic analysis. And so the better you can understand what's happening in the cycles and understand issues like why occasionally troughs look like they're in the wrong place, it's because of subtleties in the analysis. It is not going to affect your trading in any really big sense, but there are some subtleties that it is useful, I believe, to understand, because you can really see what's happening behind the scenes. The more you understand the way in which the trading signals are generated and produced, the better you understand them, and therefore the more successfully you can trade them. As you can see, the trading recommendation for the British pound to US dollar at the moment is telling us to expect a G category interaction next, which is not considered to be a good profitable trade. However, it does suggest that we consider an A category long trade. That is, if we expect that A category trading opportunity to come next. And in last month's webinar, I spoke a little bit about that. How do you know when to expect whether an A category trading opportunity is coming or not? When should you be careful, and when should you expect it? So I think on that point, I would like to bring today's webinar to a close. Thank you very much for joining me. If you have any questions, I think it would probably be best at this point if you email them to us or post them into Hurst Chat. My voice survived the full webinar, so I'm pleased about that. Thank you very much for joining me in today's webinar. Thank you very much for your interest in Hurst Cycles and in Hurst Signals. Understanding Hurst Cycles and analyzing financial markets according to Hurst cyclic principles has completely changed my life. And I hope that you are finding Hurst Cycles equally powerful in your own approach to financial markets and in your own trading. I hope that you are using them profitably. So thank you very much for your time. Thank you for joining me today. And I look forward to seeing you inside Hurst Signals. I look forward to seeing you in Hurst Chat. And we'll be doing another webinar in about a month's time, so look out for information about that. Thank you very much for your time, and I will see you soon.